everybody? Hope everybody's doing well. Welcome back to The Return, where capital meets conviction. I'm Marvin Clement.
And I'm William McCoy, co-founder of Karuti, an upcoming crowdfunding platform. So right now we're talking about the AI boom. It's everywhere, but the question on every investor's mind is it a bubble or is it here to stay?
Yeah, definitely. Reuters just published a piece titled Opinion Split Over AI Bubble After Billions Invested. It's a signal. Smart money is getting uneasy.
Yeah, and when markets get nervous, the winners are often those who lean in and not those who hide. So in this episode, we'll show you why the moment a prime attack on alternative investments is key right now. And then we'll also emphasize why crowdfunding may be a way to hedge your bets.
100%. So let's dig a little bit deeper into this. Here's what Reuters is saying. Reuters investors are divided. In a Bank of America survey, 54% believe AI stocks are in a bubble. Reuters, the Bank of England, warns a shift in sentiment could trigger a sharp correction. Voices like Goldman Sachs economists remain more bullish, but they argue current funding is large but not yet extreme. Meanwhile, infrastructure constraints, circular investments between AI firms, and exploiting valuations are raising red flags.
Yeah, that's wild. So how do you feel, like personally, how do you feel about that as an investor? I know you're an accredited investor, Marvin. How do you feel about that statement?
It does make me a little uneasy because the reality is AI appears to be moving faster than we can both capitalize on it and both understand it. And this is from somebody in tech. So will it? I'm aligned with the report in the article. But at the same time, though, I am very risk averse. So I kind of just always try to hedge and just try to keep up with the times.
Yeah, I mean, for me, like I'm all about AI. I utilize it as much as I can to make life easier, but then also to level the playing field between me and other technology companies. But I do understand where they're coming from, that AI may seem to be a bubble. On my part, I don't think it's going anywhere. We, on a previous episode, talked about jobless growth, and I think that's going to continue. I think that we're going to continue to see the jobless growth in some areas for a little while as AI takes over in more and more and more ways. So I don't think it's a bubble. I don't think it's a boom, but I definitely think that people should be looking at more than just the FANG companies or more than just the well-known AI companies, because there's a lot of up-and-coming companies that you can end up with a moonshot right now, because either they will topple some of these companies, right, because they don't see something, just like Yahoo got toppled essentially by Google, and MySpace got toppled by Facebook.
Yeah.
You will have this toppling, but you will also have an opportunity that some of these companies may actually be acquired, and so you turn your relatively small investment in these companies into a 10-time return. So I think it's opportunity in both ways.
Yeah, I totally agree. Continuing doing my personal research, I was looking at the Financial Times, and they were talking about valuation disconnects. An interesting highlight is that startups with modest or no revenue are commanding valuation multiples that defy their logic. So that's classic bubble behavior in a nutshell. So there's pros and cons and a lot of things to interpret on this here scale.
Just breaking it down for everybody out here. I mean, like for me myself, right? I use AI to break down complex terms that people put out, right? So they talk about circular capital flow. So what that means is that larger AI firms invest in smaller ones, which in turn turn around and buy their hardware, and they're self-reinforcing, right? So,
Yeah.
but they're also fragile. So again, you have a situation that we talked about where there's an opportunity with alternative investments out here to invest in up and coming AI companies that either will disrupt the big guys or will potentially be bought out by these companies. Now, they're arguing in certain cases that this could be a self-reinforcing fragility or create more risk. But in my mind, again, with AI not being a boom, personally, I don't think it's going anywhere. But I think for investors, it does definitely create an opportunity.
Yeah, that's an interesting point. Well, it's interesting too because there's a handful of mega tech firms that drive the narrative right now, and they own a dominant position of the market. So it's kind of interesting that if one stumbles, so does the sentiment of the entire sector. It's
Yeah, that's true. I mean,
yeah,
it can, and again, you never know what may happen. I mean, you know what I mean. There may be an AI company out there that's figuring out a way to not sit on the cloud. And so let's say if the cloud was disrupted, and I'm just giving this as an example. But let's say if the cloud was disrupted some way, which we have had systems, or we've had um, hacks that have disrupted whole cloud-based systems from areas. But let's say there was one major one, but there's a new company out there that's figuring out a way to have AI that sits off of the cloud and still has very, very powerful computing power. Well, let's say you invested in that AI system or that AI company early on, and somehow, some way, they became a dominant force or go-to for a lot of companies because they need cloud, they need AI, right? They need that computing. And so now they're turning to this company that has figured out a closed loop system, right, to have AI. Well, now your investment in a small company has become major. And so these are the things that there can always be opportunities, right? So execution, monetization gaps, these are the many ad plays that you could take advantage of right now. And as the sentiment turns, those without real revenue get penalized the hardest, but those with see the opportunity.
couldn't have said that any better, Will. You know, that's precisely where alternative steps in, not to replace, but to diversify, offset, and capture. You know,
So why should a sophisticated investor and care about alternatives? Well, one, again, a lot of the big funds right now are looking to move people into trillions of dollars of alternative investments between now and 2025. But also because when the public markets are wobbly, alternative investments are where you can find some asymmetry, right? Opportunity for outsized returns, dampen correlation when it comes to headline risks.
totally, very understandable. You know, we have to think too that real assets, venture capital, private credit, specialty strategies, but specifically equity crowdfunding. You know what? It gives us a bridge between public style liquidity and private upside.
So in a crowded AI market, when it's full of risks, you want ownership and differentiated bets, not just in mega cap narratives. You don't have to, you can beat the bubble uh, by not riding. You can beat the bubble by owning it in corners, right? And so what that means is you're able to say, okay, if if it is a bubble, I can still have some money in there, right? But I can be watching, and also be helpful for you to do this. You can be watching emerging markets and investing in those as well, just to hedge your bets.
Yeah, definitely. That's a great point, Will. What makes equity crowdfunding stand out? I know we said it 100 times, but so I'm going to say it 101 times. In fact, I'm going to give you a little list for those listening out there. Access to early stage innovation. So if before the valuation balloons, lower entry capital. Simple. You don't need millions of dollars to participate meaningfully, for example, you know, little as 5,000. Built-in alignment and loyalty. Backers become evangelists with accelerated growth. Optional liquidity paths. You know, many platforms offer secondary markets or eventually buyout exits, so you know you can leverage your verticals. Diversified breakout strategy. You can spread capital across 10 to 20 micro stakes to de-risk. All these are what I call good things.
And it's not a free lunch, right? It's still risk. In any investment, we want to be clear about this. We're not saying that any of these things will eliminate risk. But what we are saying is that when done wisely, equity crowdfunding lets you tilt your portfolio towards potential of 10 times returns without blowing your core money, right? And so, again, what that means, breaking that down into very simple terms, is that you are able to invest with the big guys who are taking advantage of these companies who are either disrupting or being bought out, being able to also make a 10-time return, right? But still, you can have your money in some of these core capital markets as well, getting your money there as well. And that's what these big guys do. They have their money both in their alternatives, the up and comings, and also in the big caps or the mega caps because they know the one or two things: either those companies are going to disrupt, or those companies will be bought out by this. So it's really democratizing. Crowdfunding allows for an investor, everyday investor, to democratize their portfolio.
Perfect, perfect. So I know a lot of times when we do these, we get a lot of questions at the end. So I'm a very big proponent of playbooks and step by steps. So the question we have is, how does one step into equity crowdfunding smartly? Well, here's the playbook. Number one, vet your team. Founders with domain expertise, track records, and clarity. You are the sum of your parts. Check check your unit economies early. So how does the business plan to scale? How do you move forward? How do you go vertically? Number three, you want to understand your liquidity terms. You have to understand things like your exit window, secondary market, lockups, layers and belts. Allocate only a portion. I would say 5 to 10% for your alternative bucket. Follow the capital flows. See who's co-investing. Who are the angel investors? Who are the VCs as a valuation signal? Where people are putting the money is going to show you where the value is. And then lastly, but not least, diversify by theme. Pick verticals. We've talked a lot of time about AI, augmentation, fintech, health, local service to avoid overexposure to one trend. So diversify.
Monitor your exposure is something that we always express. Again, with any investment, there's no way to de-risk yourself completely. It's just not a playbook for that yet. Maybe AI is coming out with a playbook, but it does not exist yet. But you can reduce risk by having a diverse portfolio of alternative investments combined with investing in things like AI or the future, right? Risk is an knowing which risks to take and which ones to avoid, and not necessarily which ones to avoid, right? And so to be able to do that, you want to have a good layer or a good mix of different investments happening. And some of those investments, you definitely want to start looking into alternative investments because, again, major companies are putting a lot of money. They're trying to move their big investors into alternative investments because that's going to be the future, especially as things like smart contracts make life a lot easier, blockchain ledgers and things like that. That will be the opportunity.
Perfectly said. So let's talk about a hypothetical. So Sarah, a family office principal, invests, let's say $50K across 10 equity crowdfunding deals in an AI investment venture. Health, AI tool, a supply chain optimization API, a local AI-powered logistics app. One of them exits at 8, 2 at 3. Others stall or return the capital. Her weighted return is 2.5 over a medium horizon. Meanwhile, her core public equity book is flat and volatile over the AI pullback. The alternative slice becomes the growth engine. I know I said a lot of word salad, but putting your money in a bunch of different baskets sometimes has a desired result that's positive.
Again, think about that story. She's put her investments into a few things. AI market gets wobbly. She gets one major company that hits 8 times, right? And now she's basically 2 times up on her portfolio. Now, VCs a lot of times are looking for 10 times returns. Big angel investors are looking for a 10 times return. But for me, I'm going to tell you something. If I put in $1,000, right, and I get, $2,500 back, right, I'm good. I mean, that's a great return for me, right? And for a lot of us, it would be. So again, this is the opportunity that you have with as little as $100 for a lot of these companies. You can invest little chunks of $100, right, and eventually get that return back. Somebody's gonna hit. So again, we wanted to wrap it up. This is amazing opportunities out there when it comes to AI. AI, to me, on my side, is not just a bubble, but you definitely want to have your eye on alternative investments.
Most definitely. Please take some time and head over to Karuti.com, where we're cultivating vetted equity crowdfunding opportunities and building investor networks across emerging markets. We'd love to see you there.
Talk to you soon.
Peace and love. Invest smartly.